Hey there, fellow investors! Welcome to another exciting journey into the world of finance. Ever dream of getting paid just for holding onto a stock? Well, that's not just a dream, it's a reality with dividends. That's the beauty of dividends. They are like little thank you notes from companies, rewarding you for your trust and investment. Think of them like bonuses from companies that appreciate your investment. It's their way of sharing profits with you. Now let's talk about two key things: dividend yield and payout ratio. These terms might sound complex, but they're actually quite simple. They're your secret weapons to unlocking the power of dividends. Dividend yield tells you how much bang you're getting for your buck. These tools help you size up those dividend-paying companies. The payout ratio, on the other hand, shows how much of the company's earnings are being paid out as dividends. Are they giving generously or being a bit stingy? Understanding these metrics can help you make smarter investment choices. Don't worry, we'll break it all down in plain English so you can pick stocks like a pro. Stay tuned as we dive deeper into the world of dividends and how they can work for you. First up, dividend yield. This is a crucial concept for anyone looking to invest in stocks, especially if you're aiming for a steady income stream. It's like checking the interest rate on your savings account, but for stocks. Just as you would compare interest rates to find the best savings account, you compare dividend yields to find the best stocks for income. This tells you how much cash a company dishes out each year relative to its stock price. Essentially, it's a way to measure the return on investment from dividends alone, excluding any capital gains. Here's the formula. Dividend yield equals annual dividend per share divided by current stock price times 100. This simple formula helps investors quickly gauge the income potential of a stock. So, if a company shells out $2 per share annually and trades at $50, its yield is 2 divided by 50 times 100 equals 4%. This means for every dollar you invest, you get 4 cents back in dividends each year. Not bad. A 4% yield can be quite attractive, especially in a low interest rate environment. Higher yield might seem better, right? Well, not always. A very high yield could be a red flag, indicating potential issues with the company's financial health or sustainability of the dividend. We'll dive into that soon. Stay tuned to learn more about the nuances of dividend investing and how to make the most informed decisions. High-yield stocks can be tempting, like juicy apples on a tree. But remember, sometimes the juiciest-looking ones are rotten inside. A super high yield could mean the company is struggling and desperate to attract investors. Low-yield stocks, on the other hand, might be those steady-growing companies reinvesting their profits to get bigger and better. Think of them as young trees with the potential to bear a lot more fruit later. Section 4. The Payout Puzzle. Deciphering the payout ratio. Understanding the payout ratio is crucial for investors who want to gauge the financial health and dividend policy of a company. Now let's talk about the payout ratio. This metric is a key indicator of how much of a company's earnings are being returned to shareholders in the form of dividends. This tells you what portion of a company's earnings is used to pay dividends. Essentially, it shows the balance between rewarding shareholders and retaining earnings for future growth. The formula payout ratio equals dividend per share divided by earnings per share, then multiplied by 100. This simple calculation can reveal a lot about a company's financial strategy. Let's say a company earns $4 per share and pays out $1 in dividends. This example helps to illustrate how the payout ratio is calculated in real-world scenarios. Its payout ratio is 1 divided by 4 multiplied by 100, which equals 25%. This means that 25% of the company's earnings are distributed as dividends. This means it's keeping 75% of earnings for other things, like investing in growth or paying down debt. Retaining a significant portion of earnings can be a sign of a company's commitment to long-term growth. A high payout ratio might sound generous, but it can be risky. Companies with high payout ratios may struggle to maintain their dividend payments during economic downturns. It means the company might not have enough cash left over for unexpected expenses or growth opportunities. Therefore, while a high payout ratio can be attractive, it's important to consider the potential risks involved. Section 5. The Dividend Quest Tips for Finding Your Champions. Ready to find those dividend champions? Here's the deal. Look for companies with a history of consistent or growing dividends. Check their payout ratio, ideally below 75%. Look into their industry and future prospects. Are they in a stable industry with room to grow? Great. Remember, investing is a marathon, not a sprint. Pick companies you believe in for the long haul.